Hey, if you're a private lender, you probably already know this feeling. Your borrower stops returning your text or your phone calls. Or when you do get a hold of them, they're always going to tell you, hey, I just need 2 more weeks to get this wrapped up and then you're going to get paid. Listen, your money's out there, your note is thin, and your security in the deal is probably wishful thinking at this point if you don't have everything set up straight. And what I'm referring to here is a recent individual that I spoke to who is lending and they're in this position right now. Well, in this video, I'm going to show you how private lenders can stop bleeding cash by fixing their terms, protecting their security, and using the right entity and tax posture so the next deal pays you out and not the lawyer in that deal. All right? Let's get started. Okay, so if you don't know me, my name is Clint Coons. I help investors and business owners protect their assets and keep more of what they earn. And today what I'm building or talking about is your private lending playbook. Okay, you're gonna learn why lenders get stuck, and I've seen this over and over throughout my career, is that you need to be writing lender-friendly notes and you gotta have the right security stack. So if something goes wrong, all right, your entity and what you put in place is going to be there to protect you. This is really important. So in this video, we're going to be discussing all that and breaking it down for you. Now, if you're unsure what I'm talking about when it comes to private lending, well, let me define some of these terms for you so it makes sense. So when we talk about private lending, what we're talking about here is that maybe you're right here and this individual approaches you and they want to borrow some money, all right? So you're going to loan them some money. And when you loan them some money, this is called a note or an IOU. So you're lending them money on a promissory note. And your promissory note, it's going to set all the terms, right? That is how this guy pays you back, right? Is it going to be interest only? Is it going to be over 5 years? Let's say a 5-year note. Okay, all those important things are built into there. Also, it's going to be whether or not there's going to be security in exchange for this note. So let's say this individual here needs it for a property that he wants to develop or rehab. So what is this individual owner, the borrower, going to give you security-wise to make sure that the money that you're lending him, if he fails to repay or he defaults on the note, you can go in and then sell that asset or foreclose on it if it's real estate. So security is your seatbelt. Listen, for real property, that's really simple. That's always going to be a deed of trust or a mortgage recorded against the property. Now, if you're loaning to a business, then it's going to be equipment, inventory, or accounts. And then in that situation, we're not using a deed of trust. We're going to use a UCC1 financing statement to protect your loan against those types of assets and even their bank account. You see, perfection is the key here whenever you're a private lender. And what that means is it puts you first in line. And the individual that I just ran into made this fatal mistake, right? They did not put themselves in a position where they had any pull on the borrower. And that is a crucial mistake that I see people make that want to get involved in private lending. They don't understand the importance of this. I mean, going so far even to tell the borrower you want a personal guarantee, which I would often recommend because that ensures that the borrower agrees to pay you out of their own pocket. And this is really important if you're lending to a business entity. So in this example here, if it wasn't an individual I was lending to, maybe it was their LLC, I'm still going to say, all right, borrower, I want security for the LLC, be it a UCC1 if it's the equipment, but if it's real estate, then I want a deed of trust against the real estate, and I want a personal guarantee. Now, I'm a private lender and I loan to a real estate developer, and this is exactly how I structure all my deals with them. I make sure that not only do I have secured interest against the assets, I also ensure that I get a personal guarantee from the owner of the entity. On top of that, what I want to make sure of is that you have a default interest, inside of the note, and that higher rate kicks in whenever there's a breach, all right? Now, the other things that we look at here is an extension fee. So let's say somebody comes up to you and their project runs a little long and they were supposed to pay you back. A mistake I see many times is people don't put anything in there to say, hey, if you run beyond the terms of this note, then there needs to be an extension fee. So you have to pay me more, all right? Because at the end of the day, if you're a lender, this is not charity. You're not making gifts to your borrowers. Ensure that you have assignment of rents in there. All of these are standard ingredients, and it's the art of how you combine them and time them that is critical if you want to be a private lender. Now, why do people get screwed up in this, and why is this topic so important? Okay, see, what I found is that most people lend on emotion and handshakes, and they dress them up as a promissory note and say, well, you're a good person and I trust you. Trust has nothing to do with papering your deal properly. You see, the note forgets the what ifs, right? By putting the note into place, what you're doing is you're saying, hey, this is business and you agree to do 1, 2, and 3. And if you do that, fine, here are the terms. But if you don't do it, then some things will kick into place to make sure I'm protected. Okay, you always want to make sure, as I stated earlier, that your security is perfected. And you want to make sure that when you're getting security against something, and I've seen this occur as well, that you want to check for other liens. You want to make sure there's no one else that's going to be standing in front of you. Because in the case of another lender that I ran into several months back, he was loaning money to real estate investors, but he was taking back a second deed of trust. And what ended up happening is that in a particular piece of property like this, he was loaning on, so he's loaning money to this guy here. So let's say I loaned him $75K. Well, there was another person over here that had a first deed of trust for $250,000. So your 75 went after them. Well, when the property was foreclosed on because this guy couldn't get the deal done, the only person that got paid was this one, and there was no money left for him at the end of the day. So that's why you have to make sure you know about all these other liens that are on the property, or you may not be secured. You think you are because you have the deed of trust, but that's not a guarantee, right? You always want to be in the first position to make sure that you're protected. Or the way you do that, again, if you don't have that protection here, which this person didn't do, you get a personal guarantee right down here. Now, if you're getting that personal guarantee, one of the things that I will typically do is I will run an asset search on this individual to see whether or not they have assets. So I can tell you with one of the deals I recently did, not only did when I ran the asset search, what I found is that he had a personal residence, of course, in his own name. The next thing I looked at is how many liens were filed against his personal residence. Does he have a mortgage on it? Well, what does it look like? How much of the property is secured? Because again, where am I going to get paid if I don't get paid back? It is, what type of assets do I have as collateral? So how do we structure the terms of the note? Now, I'll tell you this. Whenever you're putting together a promissory note, okay, we'll just call this a PN, promissory note for the borrower, start with clarity, all right? State the principal, state the annual interest rate, and the exact day of the month the payment is due, because all these things are important. You want to work with borrowers who stick to the terms. Once you start seeing slippage there, that tells you you're probably going to be running into some problems. Now, when it comes to defining interest, I've seen all these different creative ways in which lenders will come up with how the interest is going to be paid. I'll tell you this, just keep it simple, right? Keep it simple so you can verify it. And then know, like if the deal is a flip or is it construction, is it going to be interest only on those types of deals with the defined maturity date and not when it sells, which is another red flag that I've run into before. I mean, think on this, right? You're working with somebody who's flipping property and you put, when the property sells, that's when you pay me back. Well, what happens? And again, I've seen this where the property, it takes 5 years for the property to sell because the borrower runs into all these problems, or the borrower is like a raccoon and they see another project and they go off and work in the other project and they leave this one stagnant. Okay, you might be thinking, well, I'm getting paid. Well, are you? Because many times what happens is that you're not going to get paid because their money's going somewhere else. Your money's tied up in an asset that's not moving forward. So you have to make sure that you have this built in, that it's a clearly defined date. Now, when you're putting that together, in case it doesn't occur, you got to have a default built into it. I call this the default calendar. So if any payment is more than, say, 15 days late, then there's a default interest of 10% per annum, and it applies from the missed due date. Okay, and always include the greater of language if you're sharing a profit. Okay, so you collect the higher of the fixed return or the greater upon profit share, so you don't get pushed into a loss. Let's say if the property it goes or sells for less than what it's worth. And this is really important because I was speaking with an investor just yesterday who's looking to take on 700 acres of property and develop it. And we were talking about, in that particular note, there's going to be a profit share as far as the interest rate is concerned. And he's saying, well, what do you think the property owner is going to want in this type of deal? And I said, obviously, they're going to want to put in there some language where it's a participating note with the greater of, either the interest rate or the profit share, to make sure they get paid. So those are important things you realize when you start down the road of private lending. These are the mistakes that people make when they're not experienced. Now, extensions, this is going to come up. If you're dealing with borrowers, again, we can't plan for everything. Let's say there's a shortage on materials. so it slows the project down. All right, or it's just a tougher market when it comes to selling the property. So the borrower may end up wanting an extension, so you have to put in there a clause that the borrower can, of course, request an extension. Now, you don't have to. Let me rephrase that. You should put in there or be thinking about it, right? Maybe you give them one extension. So in my notes, I'll give the borrower a request for one single extension for up to 60 days upon payment of an extension fee that's equal to 1% of the outstanding principal. Now, that's at my discretion. So what it means is this, is that if I'm working with someone and I'm looking at the reasons why they weren't able to pay me, I think, all right, I'll waive the extension fee. I'll give you a 60-day extension. Great, I can do that. But at the same time, if I feel like they're trying to screw me a little bit here, then I can impose that 1% extension fee on there. So what this does is it protects you because it's your money. And if they miss their obligations, then it comes at a cost. Now, the other thing I would do is I'd make fees due on request, and that's really important as well. So you have to define the events of default beyond just missed payments and when these fees are going to be due. So what am I thinking of here? So unauthorized transfers, that should be in your note. If there's ever any liens, senior liens that are applied to the property, like a materialman's lien or a labor lien, lapse insurance, waste, or failure to provide even a monthly status updates with photos and budgets, all these things are really important and they can result in a fee. And then another aspect of it that you should be looking at is lender remedies, all right? So what happens when these things are missed? You can put in there that you could accelerate the balance and enforce the security and collect those fees at that point in time, especially attorney's fees. So if you need to hire an attorney, you better have a provision in there that addresses attorney's fees. Otherwise, you're not going to be able to get those many times if you have to go to the legal system in order to get paid. Now, when it comes to private lending, I want you to think in layers, okay, about how you're setting this stuff up. Now, this is important here, and it's an aspect that just came up with a different client with private lending. So what they did was this. They have a Wyoming LLC right here that has a bunch of cash, savings, stocks inside of it. Now, they had heard, and probably from one of my videos, that I refer to notes, deeds of trust, as a safe asset, okay? So what that means is that when you loan someone money and you get a note and a deed of trust against the property you're loaning against, this, what you take back, okay, that's not a risky asset. Meaning, if somebody slips and falls on this property, if you're a lender, you're not legally liable to that injured party. It's the owner of the property. Maybe it's an individual. Hopefully they're smart enough to do it through an LLC. That's going to be the responsible party. So having a deed of trust on a house is not dangerous. So you can take a deed of trust and you can put it with savings or stocks in this Wyoming limited liability company because it's never going to result in a lawsuit. That means that LLC isn't going to get sued because it has a deed of trust against a piece of property. Okay, so here's where the problem came in this particular situation, why an entity stack is important here. So what happened is that this borrower here defaulted under the note. And so the note was drafted very well. And so all these provisions kicked in that allowed then my client here that has this LLC to take this property to foreclosure. So they foreclosed on it. And there's a large sum of money that's owed, the money that they loaned, plus all the fees and penalties that went along with it. Now, they anticipated that at foreclosure that someone would come in, scoop up the property. So let's say that they were owed $300K. Well, they value the property at $425, so they assume that somebody would come in, maybe bid $325 for the property, so they would get their $300,000 out of that. $25,000 would go to the owner of the property, and then the new individual would take it at $325,000 at foreclosure. Well, that did not happen. And since there were no bidders on the property, they ended up getting the property for what was owed. So they just bid their debt. That's how it works. So now we have this problem right here. And that is their Wyoming limited liability company owns a piece of property, which is a dangerous asset, and that has a tenant inside of it. So they have their savings inside of here. They have other notes. They have their stocks. And now they have real estate. Okay, so you can imagine the stress that these clients are under. They want this house out of the LLC. They don't want it in there, and they're blowing up my cell phone. Yes, they're one of those clients that do have my cell phone. They're a titanium client that I've worked with for years. And so they need to get this property moved out. So what we had to do then was rapidly put together a new limited liability company over here and then deed this property out of this LLC. And when I say rapidly, it took us 7 days to get all this done. Now, how do you solve this problem then? Okay, in the event that you have to foreclose. Now, I've been lending for several years and I've never run into this issue, but it made me rethink what I'm even doing with my own lending. And I want you to pay attention here because this is really important. So when I reached back out to the client after all this was done, I said, okay, for your next deal, I want you to think about this, okay? 2 ways to put this deal together. All right, when you loan someone money, one way to do this is to set up a separate limited liability company here. You set up a separate LLC, and this LLC would be owned by this Wyoming LLC. Now, this limited liability company, it's Wyoming, it's going to hold the deed of trust, okay, against the property. So it's going to hold the deed of trust against the property, right? So your stocks and your cash still say protected down here, down in this entity. If anything were to go wrong and you were to foreclose, then the property flows into here and not into here. So we got there, right, with the structure that we were to put into place for them. But remember, there was a time period there, 7 days, where that property is with their safe assets. Now, by setting up a separate LLC per deal, you accomplish the same thing, but from the outset. So should something ever go wrong, boom. Now, the thing about doing it this way, all right, so you set up, if you're only doing one deal at a time, you can just keep reusing that same limited liability company. Every time you get paid back, great, then take another loan out, but just do one deal per LLC. So let's say you're lending on, like in my case, I have 3 deals going on right now. I'm going to look at creating 3 LLCs to do 3 separate deals like this. So if I have to foreclose on any of them, then it would be the LLC that holds title. Now, another option, okay, and this requires you, I think it works just as well, but sometimes these things happen so fast and you get so wrapped up in the emotion side of it, you don't contemplate what's going on, and I explain this to them. Another way we could have done this deal is to set up, so here's our Wyoming LLC right here, right, with all their cash and everything else inside of there. What we should have done is they should have reached out to me before we got to the point where they had foreclosed on it and said, hey, Clint, we're going to be foreclosing on a property that we have a first deed of trust on. And in that case, what I would have done is said, okay, let's do this. Let's jump in here. Let's create a Wyoming LLC, and we will assign the deed of trust and note to the Wyoming LLC. So now when you foreclose, it rolls into this LLC and it doesn't roll back in here to the parent. So in order to do that, we need a little bit of runway, right? And so typically you're going to have that runway from the time in which you recognize the default to the time in which you foreclose on the property. So this is a flexible way as well. Now, the only drawback I would see with the waiting process of setting this up after the fact is the assignment, right? Making sure that gets recorded in time before the foreclosure and it's recognized at the sheriff's sale, so they don't put title back over here because they haven't seen it recorded yet to know who is the proper holder of that note. So there is some risk there in using this secondary strategy, but I think it works as well. And I don't think going forwards it's something I'm going to be doing. What I plan to be doing is setting up separate LLCs then for each of my deals to keep them completely separate on my private lending. So, this is the entity stack that I like to use now going forwards. There's lots that goes into it if you're going to be a private lender. That note, though, is critical. Those provisions that I was throwing out there in this video, be sure you check your note, making sure you have all those types of bases covered, because at the end of the day, it's your money on the line. And if somebody's coming up to you and they're going to borrow money from you, you want to make sure that they understand, hey, this is your obligation. If I'm going to go out on a limb and take this risk, okay, I expect you to live up to the obligation, the terms of the note. If you don't put that together, then you're just going to find yourself spending a ton of money in legal fees to get just back to being whole. And that doesn't even count, when I say whole, that's just possibly, hopefully getting your money back, your original loan back. But what is the cost of going through all of that? If you haven't provided for that, then you're going to lose on that side. Hey, if you like this video, be sure to hit the like button. And if you're a private lender or you're thinking about getting started in private lending, I'd highly encourage you to seek out a free strategy session here at Anderson. If you go into the show notes, I have a link in there. You just click on the link. You can then set yourself up with a free 45-minute strategy session with one of our advisors, and we can walk you through how to create the right entity stack for your private lending business and talk through the issues that I brought up here. And this doesn't even mention the tax planning side that can come into building this business around private lending. I wish you all the very best with your investing, and be sure to check out my next videos as they get released on a weekly basis. Take care.